Hello and good day, everyone. Welcome to the ENSafrica webinar on the medium-term budget policy statement. I will be putting up a slide deck to introduce the discussion we'll be having with you today. But the format for this afternoon's discussion will be that of a panel discussion. Three of my colleagues and I'll be moderating and facilitating the discussion. And my colleagues will deal with certain of the tax proposals which have been made in conjunction with the medium-term budget policy statement. Now, in order to set the scene for the discussion this afternoon, I'm going to put up a slide deck which sets out some of the key points that we will be discussing this afternoon. From a housekeeping point of view, I would like to point out that you should submit your questions via the Q&A, not the chat function at the bottom of the screen. The webinar is being recorded and a replay is being made available on YouTube for anyone who is unable to join now and wish to watch it at a later time. Now, what we know thus far, the medium-term budget policy statement was released on 11 November 2021, also referred to as the mini budget. It focuses more on the expenditure side than the income side of the budget and indicates how government intends allocating the upcoming national budget. It does play a critical role in the entire budgetary process because it sets the tone for the fiscal framework, which refers to the broad budgetary aggregates of total revenue, expenditure, and borrowing. Now, our goal this afternoon will be to look at the total revenue component of that fiscal framework, not so much the expenditure on the borrowing side, because as you will see from our descriptions, we are all direct tax specialists within ENS, not economists, and therefore we focus on the tax aspects of the medium-term budget policy statement. Now, the context in which the mini budget took place is that South Africa has experienced several shocks: Eskom, electricity constraints, COVID, as well as the outbreak of public violence in KZN and Gauteng earlier this year. The effect of all these events have been to virtually eliminate the fiscal space government requires. And the theme for this afternoon's discussion is to look ahead, utilizing the lens, through the filter of the mini budget. In the hope that there are no further shocks, it is anticipated that we move into a fiscal surplus in 2024, 2025. But over the next few years, spending will remain restrained. And to fund the budget, what's anticipated is that government will be making use of short-term tax windfalls. And that's part of the discussion we're having this afternoon, where those windfalls are likely to occur within the economy and who's likely to be affected by it. But also the transitory nature of those short-term windfalls, that the commodity revenues, some of the taxes that you see being collected from mining sector and others is unlikely to provide significant additional revenues beyond the next tax year. Now, this diagram we took from the full medium-term budget policy statement. What it shows in the top line is that the 2021 budget had certain projections for total tax revenues. Those estimates were revised. So the revised estimates are higher than the numbers in the 2021 budget. However, there's a tax buoyancy calculation that's also made, where the tax buoyancy is a relationship between total tax revenues and economic growth. A value above 1 means that tax revenues are growing faster than the economy. A value below 1 means that tax revenues are growing below the rate of GDP growth. We have seen a sharp increase in 2021, 2022, with the tax buoyancy ratio is 1.73. And that's largely due to improved collections from the mining sector, manufacturing, finance, but then much lower projections for 2022, 23, and subsequently, with the tax buoyancy numbers sort of a break-even number or below the rate of the economic growth, even though the amount of tax revenue is projected to increase. And one of the points that we're going to be touching on today is just steps that SARS will be taking in the search for the tax base to reduce the tax gap and to increase the tax base from which taxes can be collected, and the sort of things that taxpayers should really be mindful of. The the bills, the tax bills, which are tabled during the mini budget, there were other bills as well, such as division of revenue, but that tends to split up the pie between the different departments, whereas we're focusing more on the bills that will be used to generate income on the income side of the budget. Again, not so much the expenditure side of the budget, but our focus is more on the income side of the budget. And these bills are the Taxation Laws Amendment Bill, Tax Administration Laws Amendment Bill, and Rates and Monetary Amounts and Amendment of Revenue Laws Bill. So with that brief introduction, we will move into the panel discussion. And at this point, I'm going to ask my panelists to give a brief introduction. Again, my name is Mansoor Parker. I will be facilitating the discussion between our panelists this afternoon. If I could ask you, Anas, followed by Mangaliso, and then Ntebaleng, to say a few, to give a brief introduction.
Good afternoon, everybody. My name is Anas Kameh, and I'm an executive in the tax department. I specialize in corporate and international tax.
Good afternoon, everyone. My name is Mangaliso Nzimande, executive in the tax department, and I specialize in corporate tax and tax dispute resolution. Thank you.
Good afternoon, everyone. My name is Ntebaleng Sekavate. I'm an executive in the tax department, and I specialize in mergers and acquisitions, mining, and also tax dispute resolution.
Okay, thank you very much, Anas, Mangaliso, and Ntebaleng. Looking forward to discussing the mini budget with you this afternoon. If I could start off with you, Anas, one of the points that came through in the slides that we selected was the question of tax windfalls. And one of the points that came up is that it was higher than projected, but it's unlikely to continue into future years. What do you see, or what have you picked up from the medium-term budget that these tax windfalls will be used for? Sorry, you're on mute.
Actually, the Minister of Finance actually showed us a table in the budget presentation where these higher than expected tax collections actually enable the government to respond to the COVID-19 crisis and the other social needs that we had in South Africa over this period. They were able to provide a fiscal package of close to 40 billion rand. And the majority of this package, which was, I think they said about 36 billion rand, was funded from these improved tax collections. So of the 40 billion, 27 billion was or will be spent on the reintroduction of the 350 rand special COVID-19 grant. This will continue until March 2022. Then another 3.9 billion will go to SASRIA, which is the state-owned insurance association. And they mentioned that this was mainly to ensure that SASRIA will be able to pay out claims to businesses that were affected by the recent riots and the unrest where it resulted in damage to their property or goods. Then an amount of 5 billion will go towards the employment tax incentive, which has been very well received. And then small businesses that were affected by COVID and the July public violence will also receive 1.3 billion. And lastly, just under 1 billion, 950 million will go to the SAPS and the SANDA.
Thanks for the overview. Now, I'm sure you were as surprised as many of us were to see the spike in revenue collections occurring, given the dire predictions that preceded the medium-term budget. What do you attribute the success to in this in this spike in tax revenue collections?
Yeah, Mansoor, I must say I was quite surprised. But in SARS's media release on the medium-term budget, SARS explained that revenue collections were trending well above the estimate set out in the February 2021 budget. In fact, all the major tax types recorded a year-to-date surplus against the estimate. The surplus for personal income tax was 6.3% above the estimate. The surplus for corporate income tax, 51.8% above the estimate. And then that also resulted in a small surplus of 0.1%. So there wasn't one particular tax revenue stream that gave rise to the results, but SARS attributed the increase to three main areas. The first, they said, was the improved economy. Second, they attributed the increase in the revenue to various compliance incentives which they had put in place in prior years already. And lastly, they said that it was as a result of their focus on improving collection efforts. It is quite apparent that the revenue performance at half year reflects an economy that's recovering to almost pre-COVID times. But what I find interesting was that in that media statement, SARS mentioned that it had collected 87 billion rands from these identifiable compliance activities during the first half of the year. Of that amount, 54 billion was collected in cash revenue, but a large portion, almost 40%, which is 34 billion rand, was secured through fraud prevention mechanisms by SARS.
Thank you. Thank you very much for that, Anas. And Tebaleng, if I could switch over to you on this point, because it felt like the mini budget, there were some optimistic words, and then there were also some cautionary comments. So apart from the year that for the surprisingly high revenues, there's also a statement in the mini budget that several tax bases have been revised lower relative to the 2021 budget. And which brings up the whole question of how does one expand the tax base, as well as the question of the tax gap, which is something that featured quite prominently in the SARS annual report and the SARS strategic strategy reports, where they said that they're doing an assessment between the amount of tax actually paid and the amount of tax which theoretically can be collected from the South African economy. Do you see these downward revisions in the major tax bases as evidence of this tax gap that SARS has referred to in their policy, in their operational documents?
Thanks, Mun. So I think the question of this tax gap is quite an interesting question. And I'd just like to refer back to that tax buoyancy slide that you shared earlier, which showed that for the current period anyway, for the 2022 financial year, tax collections actually exceed the growth of the economy. So the question is, where is this tax gap? Because the economy doesn't seem to be doing so well, but the attitude seems to be sort of the money is out there somewhere. Now, various studies have been conducted on this concept of a tax gap, and the Davis Tax Committee also looked at this question, and they found that there was a tax gap of about 50 billion rand. And Judge Davis actually said this was a conservative estimate. So the question is, how do you go from the estimate to actual figures where we can say, solidify this is how much, this is where the leakage is. So the areas that they identified was that losses were emanating from the customs, VAT, and high net worth individuals were three of the areas of non-compliance that were identified where this non-compliance was happening, resulting in this tax gap. So at the moment, I think it's nice to have estimates and to say this is probably where the leakages are happening. But whether that can actually be solidified, whether that's a reality, and whether that tax gap can in fact be closed is a different question, I think.
Thanks a lot. I'd like to switch over to you now, Mangaliswa, but just something that emerged from your point in Ntebeleng is that I've noticed sometimes in references to the tax gap, sometimes it's referred to in rand terms. So it's said that there's a tax gap of 50 billion or 200 billion. In other cases, referred to in percentage terms. And it just seems to me that intuitively, a percentage-based reference would make more sense than a rand-based reference. Because if we have, say, a base of 1 billion and there's 100 million, that's the gap that could have been collected. It works out to 10%. But if that $1 billion rand grows to 2 billion and 100 billion remains the same, it seems as though the tax gap hasn't changed in rand terms, but in percentage terms, it's actually gone from 10% to 5%. So it's actually been an improvement in collections. Do you find that there's a consistency in the way this topic is tackled, that the measurement criteria is consistently applied in Ntebeleng, or is there a need for a more consistent measure as to how one looks at this in order to determine whether it actually exists?
Yeah, that's a good question. SARS uses a top-down approach and a bottom-up approach, right? Where they actually use figures that are available to them, and then they use sort of empirical evidence that they find in other areas. Now, the interesting part is if we're saying the tax buoyancy is over 1, and therefore tax collections exceed the growth of the economy, then what is this empirical data we're using? Are we looking at the state of the economy to say, well, this is how much we think we should be collecting, and we are falling behind on that? But then your buoyancy says something different because it says your tax collections are exceeding the growth of the economy. So it's quite an interesting question, and I'd be quite curious to see. It seems like areas have been identified, and SARS is taking steps to sort of address this, like they're focusing on high net worth individuals, for instance, and all this VAT fraud that they say they've identified. But it would be quite interesting to see how you actually quantify the amount of this tax gap, and if you can, and how, when you take measures to close the tax gap, how you measure the success of those measures.
Thanks a lot. I think that's a good opportunity for you to come in, Mangali. So just
and
what in your experience? Okay, sure. Before I ask you a question,
I just wanted to add to that, Mansoor, because there's varying studies when it comes to the tax gap, and I've seen some which put it as high as 200 billion rands. And I think the key is to properly quantify what the tax gap is, so that it's clear for everyone. Because currently, I think there's varying studies, and no one is really sure where to put the figure as. Because Ntebeleng said the Davis Committee put it at 50. Some studies put it as high as 200 billion. So I think it's quite critical to also just try and get as much as possible a number that is. I'm sure that it's almost impossible to get an accurate number, but to try to get a number that everyone across the board sort of agrees with, because I think it's an important issue that needs to be dealt with, to understand exactly what that gap is.
And in your experience as a tax practitioner, what do you find happening on the parts of taxpayers that leads to this gap, where SARS says you should have been paying more tax than what was actually paid in? What do you find are some of the factors that contributes to this difference?
There's a number of varying factors, Mansoor. Some innocent, where basically errors from the taxpayer side, or taxpayers basically not taking enough care when completing their returns. And there are some more serious, where it's basically flagrant tax cheating or flagrant tax fraud from the part of the taxpayers by way of tax evasion or tax avoidance. And I think those are the two that SARS would be worried about, where it's just flagrant tax avoidance or tax evasion and tax fraud. So, and of course, the issue of the tax gap is not unique to SARS or to South Africa. It applies to tax revenue authorities across the board. But I think what we are seeing from the measures, and what we'll discuss later on, is that SARS is implementing measures to try and close that gap as much as possible. And I think it's starting to show results from the numbers that we are seeing in terms of the revenue collection perspective.
Now, we had a very interesting case recently, and it just arises from what you've just said, the SPER case concerning the contribution to the trust and the share incentive scheme matter. And I'm asking not so much on the tax side of the incentive scheme, but there was a prescription issue. And one of the issues that arose there was the manner in which the income tax, the corporate tax return was completed by the taxpayer.
Yeah.
Where you shut the door to prescription if there's full disclosure made in the return, which the court found was not done in that case. So I guess that's also one of the points that can emerge, that taxpayers must be very careful in what they disclose in their returns, because otherwise that door, which one would think would be shut due to prescription, actually remains open, and they can then be assessed years into the future.
I definitely agree, Mansoor. And in fact, the judge in that case didn't really take kindly to the kind of mistakes or the alleged mistakes that the taxpayer made in their tax return. So the judge didn't really take kindly to that, and in fact was not of the view that there were mistakes. So I think it's important for taxpayers to be very careful when they are completing those tax returns.
Thanks a lot. If I could move back to you, Anas. The mini budget refers to low-hanging fruit that SARS wishes to exploit in order to collect more taxes. And it also speaks about increasing compliance and broadening the taxpayer base. Just from your interaction with clients, what have you been seeing? What are some of the trends or the things that you've been picking up of steps being taken and enforcement measures being taken to try to increase the revenue collection that taxpayers should be wary of?
So, Mansoor, I think most recently, obviously, the draft taxation laws amendment bill was published, like you alluded to earlier, and I think that legislative process has now come to an end, where National Treasury and SARS presented their response documents, obviously to the public comments, to the Standing Committee on Finance, I think just last week. There were a few significant proposals in that tax bill, which focused on increasing revenue collections to try and close this gap. On the corporate income tax side, for me, the most significant was the proposal to strengthen the current rules dealing with the limitation of interest deductions owed to certain persons, essentially those persons that are not subject to tax. In fact, this measure was first proposed before COVID reached South Africa, and National Treasury explained that they see the current rules as a very important tool to mitigate the use of excessive debt and interest payments being made, and thereby reducing taxable profits in South Africa. So National Treasury is still of the view that these rules need to be strengthened, but because of the impact of COVID on loss of earnings for businesses, and to give companies some sort of breathing room, the proposal will be delayed. Secondly, on the personal income tax side, a very recent measure which we've seen is the appointment of the first director of SARS's High Net Wealth Individuals Unit. And this ties into the point that Ntabeleng made earlier about where the perceived tax gap was or is. On this point, the commissioner mentioned that the initial selection of individuals was about 1,500 individuals, but they also said that they would extend their reach further based on the information that they have already and will be exchanging with overseas tax authorities. A number of our clients and a number of individuals have already received a welcome letter from this unit as SARS, which is a good indication that the unit is up and running, and is a good starting point that they intend to deliver on their mandate to enhance compliance from these individuals and increase the revenue collections from this segment of the tax base.
Were these letters sent from the high net worth unit within SARS to particular individuals?
But that's what we've seen so far. We've just seen the welcome letters.
Okay, okay.
It's a good indication that, the unit is there. And I think that, as they get up and running, we'll see further correspondence coming.
Yeah. I had a funny anecdote once where people were having a dinner party and the one person had received a letter from the high net worth unit, but the other dinner guest hadn't, who thought his net worth was also quite high. Should also be receiving a letter as acknowledgement of the high net worth. But I think what you're saying is that the enforcement net does seem to be closing on particular taxpayer types and particular taxpayer segments. Because I know SARS went through this period where there seemed to be a removal of certain of the more specialized units, but it seems as though that trend is now changing again, and we're seeing the emergence of these specialist units within SARS. Yeah. The and Tebaleng, if I could get back to you, Anaz mentioned a few initiatives, and we'll go into them a little bit deeper during the course of the webinar. One of which was the limitations to be placed on interest deductions. There was also a lot of time taken up in the bill on limitations of assessed losses.
Yes.
Would you care to explain to us what the thinking is behind that and where we are on that issue?
Sure. So currently, taxpayers can carry forward their assessed losses. So the idea is if you were in a loss-making position in 1 year, you have an accumulated tax loss, and then you can carry that forward to the next year, and you can set that off against your taxable income. So in essence, you only pay tax on profit, on true profit year on year, as you make your taxable income. Now, the proposed amendment that came out earlier this year was that the assessed losses that can be utilized against taxable income be limited to 80%. So you can only use 80% of your assessed loss balance carried forward from a previous year or your assessed loss in that year that arose, and the balance will have to be carried forward. So that technically means taxpayers could be, paying tax in years where they actually have an accumulated assessed loss, and they'd have to just keep rolling it forward. And the intention of SARS with that seems to be they just like to smooth out the collection. So in industries that are very cyclical, for instance, like mining or agriculture or sectors like that, you could have one really good year and then one really bad year, so then the tax collections are sort of up and down because you keep carrying forward this loss and then you could use it up in 1 year, etc. So it seems the intention seems to be to kind of smooth out tax collections so that they could probably better estimate what tax will be collected in what year, and to not have a roller coaster situation where there's high profits in 1 year and big losses in another, and then that has an impact on the amount of tax that's payable. So I think by doing that, I don't know if SARS will collect a lot more tax, but I think they will see more consistent tax flows, and I think that's the intention behind that.
What we also see in these moves is that I mean, to put it simplistically, to determine tax liability, we've got to first calculate what goes into the pot, and then determine what we can take out of the pot, and whatever remains in the pot we multiply by the applicable tax rate. But the way to increase revenues is not necessarily to tinker around with the rate, because if one reduces what you can take out of that pot, then there'll be much more left that can be taxed. And we've seen this issue, I think, Anaz, in the context of incentives, where the Income Tax Act has various incentives. And over the past few years, National Treasury have said that sunset dates will be introduced into these incentives, particularly those which do not have sunset dates currently, and that reviews will be performed. And to the extent that the outcome of the review is negative, these incentives will simply expire or be allowed to expire when the sunset date is achieved. Do you see that approach becoming more and more prominent, that instead of new tax proposals as such, that there is a desire to eliminate some of these concessions that's given to taxpayers within the Income Tax Act?
Yes, Mansoor, and very much so. And I think that this position has been made clear by National Treasury over, the last couple of years. Certainly, the number of incentives have been reduced, and I must say, it's mostly, as National Treasury have said to us, where taxpayers are abusing incentives, where the incentives are not being used for their intended purpose. And they need to limit those incentives, because like we keep saying, we need the tax revenue for the real work that we need to do in South Africa.
And there's also situations where the person's making use of the incentive might just simply be too small a group of people, because we do have situations where there's some deductions that's used by a far wider group. It costs the fiscus a lot more, but it's a lot more beneficial to the broader population, whereas incentives that's used by a very small and exclusive group is probably not likely to survive the review.
Yes, exactly, Mansoor. And that just comes back to the point of, when they introduced the incentive, there was a specific purpose that they had in mind for that incentive. But if it wasn't being utilized by taxpayers in that manner, or it was being abused, like we saw with the ETI incentive, then they have to, and they are bringing those incentives to an end.
Thanks for that, Anas. Mangalisa, if I could return back to you, what other measures have you seen from a capacity point of view? We've seen SARS taking in order to improve their ability to collect taxes?
Thanks, Mansoor. I think the most important is the efforts that SARS has been putting in terms of increasing their capacity and efficiency on their systems. And I think we've also saw in the mini budgets, the minister mentioned that SARS has already started utilizing the additional funding that it got in the budget to basically hire more skilled tax auditors, data technology, and also just to improve the tax system as well. So I think the key focus for SARS is on that capacity to make sure they have the right staff, the right skilled staff, to make sure that they go out there, they do the necessary audits and they collect the revenue. So I think the key focus for SARS is on the capacity side to enable them to close that tax gap as much as possible.
We've seen developments, Mangalisa, in this area around, say, crypto assets, a newer area. But SARS have said that it's taxed like any other financial instrument, like any financial asset that needs to be subject to the tax rules, and that there's many taxpayers, individual taxpayers, who would ask, but how will they possibly know if I'm buying or exchanging? And there is the mechanism in the Tax Administration Act where SARS can request data from third parties. Which they will use. Have you seen use being made of that as an effective enforcement tool?
Definitely, Mansoor. And I think that it also speaks to the confidence that SARS has gained by employing these skilled tax auditors. And we're seeing it in practice with the quality of audits that they are doing as well. So they are utilizing the skilled auditors, and they are utilizing the technology that they're investing on as well.
Okay. No, thanks a lot. If I could just take a slight turn at this point. At this point, we'll be discussing some of the broader trends and enforcement steps. One of the issues that came through in the mini budget in Tebeleng is the windfall revenues derived from the mining sector. And just allow me to read what the mini budget said. It said the mining production increased by 25% in the first half of 2021 compared to the same period in 2020. And this recovery to pre-pandemic levels was supported by higher global prices and strong demand. Do you think that Treasury will look for any other mechanisms to maximize tax collections in the mining industry?
For sure. And I think, that was illustrated by the proposed amendments that were set forth in 2020. And it was quite a strange time, actually, because we were right smack dab in the middle of COVID. And the proposed amendments to Section 36 of the Income Tax Act were that only mining right holders would be entitled to claim capital expenditure allowances. Now, the capital expenditure deductions that are given to mining companies are quite significant. And the reason for this is because mining requires a significant upfront investment, right? So in order to recoup that investment over time, then they give you your capital expenditure allowance, which you can deduct against your mining income until you have essentially exhausted that capital expenditure balance. So miners can go a long time without paying tax. And so the amendments now, obviously, there's a definition for what mining is and what capital expenditure is, and it's not only limited to people that hold mining rights. So we've got contract miners who carry on on behalf of a mining right holder. We've got people that win minerals from dumps, which are not covered by the NPRDA, so they don't have to have a mining right, but they are also entitled to capital expenditure allowances and the like. So that was quite a shocking development, those proposed amendments, and they were quite passionately opposed by many in the mining industry, and then we saw National Treasury not introduce them and kind of put them on ice. But I don't think we've seen the last of those proposed amendments, and I think maybe we should, expect to see something similar in the future. But the issue with this is it has a wider impact. If you think about joint ventures where a BEE partner will be the mining right holder and they're going to a joint venture with another entity, which is the contract miner, then the capital expenditure allowances would be completely lost. However, there would be a great source of tax for SARS, and the Davis Tax Committee did say that these capital expenditure the CapEx allowances need to be looked at because they might be overly generous to miners. So I definitely think there's some uncharted territory there as far as levying tax on mining companies. And there's definitely a lot of tax to be collected by SARS if they do introduce these proposed amendments in the future. And that together with this limitation on the assessed losses could be quite significant for mining companies, because if suddenly you've lost your CapEx allowance and your assessed losses are limited, then you might find yourself with tax bills year on year that you haven't had before. So I definitely think that that's an area that SARS will probably, or National Treasury will focus on, especially seeing, these commodity booms and just the potential of how much can be actually collected from this industry.
Thanks a lot. Do you think that the decision to withdraw those proposals, were they motivated by the fact that Treasury thought the proposals were good, but the timing was bad? Or B, Treasury were persuaded that the proposals weren't quite workable, and that's the reason why it was withdrawn? And depending on A or B, what do you think the prospects might be for them to revisit this issue and put it back on the table?
I think it's both A and B. When we had just come out of the first sort of initial hard lockdown and these proposed amendments came out, obviously most mining companies had to close completely, right? The coal miners were allowed to continue operating, but that was at like 50% capacity or something like that. But a lot of mining operations had to close down, and it was not a good time financially to try to sort of introduce these kinds of wide-ranging amendments. And also, I don't think, and I could be wrong here, but I don't think there was a lot of unintended consequences which would have come along with these amendments, which we did responses to National Treasury. We just pointed out, you're going to, now the BE JV arrangements won't work anymore. Contract miners, who also have to put out a large amount of investment into the equipment because they provide the equipment and so forth, will not be able to claim these allowances. And the mining right holders who don't necessarily incur this expenditure will have the right to claim it, but will have nothing to claim. So I think there was a timing issue, but also technically, I think there was a lot of unintended consequences which would have come along with this. But I don't think we've seen the last of it. I certainly don't. So I think maybe someone's still finessing it and thinking about all these things that were raised, but certainly I do think we haven't seen the last of this.
Okay. Now, it does create a very interesting issue around the introduction of new tax proposals, because the proposals are given, then we have a limited time in which to comment, and we often rely on industry bodies to give those comments into National Treasury and SARS. And when you mention these proposals and just the broader economic impacts that it has, there is the risk that tax proposals can go through, but then the impacts are only felt later because the analysis isn't done upfront on what the broader economic impacts of a particular tax proposal could be. Are you hopeful that there might be a different approach to how this could be dealt with in future, so that we avoid these sorts of cascading impacts in the economy?
I'm hopeful that they will shelve these proposed amendments indefinitely. That would obviously be the best sort of outcome for the industry. And I think the reasons why these capital allowances were introduced in the first place still exist, you know, and although you might not have as many new mines that are being started, there is a lot of capital expenditure, you know, that goes into these projects, and I don't think that to add an extra tax burden on this very, very critical industry, you know, that actually is the source of so much tax funding, might be wise, because, you know, you don't want to kill the proverbial golden goose. So, yeah, I'm hoping that if we do see these proposed amendments come out again, that they're not as draconian, and that they are a bit more lenient to taxpayers that carry on mining activity.
Okay. No, thanks very much. Thank you. The Mangalisi, if I could get back to you, because it's one thing if there's a commodity boom and prices are high and goods are sold and therefore tax revenues increase. But as the mini budget states, those are transitory. They're not permanent. What do you think would be done after there's a boom, in order to keep the tax collections quite high, and steps that taxpayers should be mindful of?
Thanks, Mansoor. I think there's not much that can be done, unfortunately, because as you said, the profits in the mining sector are cyclical. We're currently in a boom, and I think the commodity prices are already starting to soften. And the minister did recognize in his speech that it's only temporary. So I think what the minister, and he did in fact say this in his speech, is that they'll be relying more on SARS, on SARS's efficiencies, basically to collect more revenue, to enforce compliance. So I think the pressure will really be on SARS basically to step up once the commodities boom has gone to bust. So the pressure will definitely be on SARS to step up on the collection side and enforcement side, to make sure that those revenues do increase as planned. So there's going to be a lot of pressure on SARS, especially to make sure that they carry out the audits and collect that revenue as well, so that we do have that steady increase in revenues. It's going to be difficult. And as you said earlier on, looking at the buoyancy predictions by National Treasury, they do take into account that once the commodity price boom has gone down, we're likely to see a decrease in tax revenue compared to economic growth. So I think the pressure is definitely going to be on SARS to collect more, which then means that we're going to see more audits, more disputes with SARS, and therefore taxpayers should definitely take this into account and prepare for a more aggressive SARS going forward.
In order for taxpayers to de-risk themselves when they take tax positions, what are some of the mechanisms available to them in terms of SARS binding ruling processes and other aspects that they should consider when they enter into transactions where there is a possibility that SARS might take a different view on the tax treatment or their tax position?
Yeah, I think it would be important for taxpayers to go for those private binding private rulings before they go into those transactions, just to make sure that they get a bit of certainty of how SARS is likely to treat the transactions. Because as I said, SARS is scaling up. They're scaling up on more tax auditors, which means we're going to see SARS challenging more and more, or even looking at more and more at the taxpayers' transactions and looking to challenge those transactions. So taxpayers should consult, and where they can, they should definitely go for those binding private rulings just to get a bit more certainty going forward.
Okay. If I could, thanks, Mangali. So, Anaz, returning to you, one of the key issues in the tax proposals has been the limitation of interest deductions. It is quite a technical amendment. And I know that you had mentioned this at the start when you gave the overview of some of the steps that could be taken to broaden the tax base and to improve collections. Could you just touch on the proposals that's been made and where we currently are in order to strengthen those rules dealing with the limitation of interest deductions?
Yes, sure. So just so that everyone is on the same page, these rules were first introduced into the Income Tax Act in 2013 in section 23 capital M. And like I said, the purpose was to prevent South African taxpayers from eroding the tax base in South Africa by paying interest to creditors that were not subject to tax in South Africa, so mainly to non-residents, and also where the debtor and the creditor had had a controlling relationship, so that they were related to each other. In 2020, Treasury published the position paper or discussion document in which it compared the rules that we had in South Africa limiting interest deductions to the recommendations made by the OECD under BEPS Action 4. And the purpose of the most recent proposed amendments, when we talk about strengthening the rules, is to align South Africa's position with the OECD recommendations. So like you say, Mansoor, the provisions are quite technical, but there are three main changes, which I will explain. The first is a broadening of the definition of the term interest. And it's going to include, amongst other things, foreign exchange differences. The rationale for this change is where SARS or National Treasury are of the view that taxpayers may enter into avoidance schemes where payments which are economically linked to interest are labeled as other types of payments to avoid the application of this provision. So the first is a broadening of the interest to which this provision applies. Then secondly, so currently the provision limits interest deductions to an amount calculated with reference to a company's adjusted taxable income, and that is then multiplied by a percentage. And that percentage is calculated in terms of a formula. The second proposal is that the percentage calculated in terms of the formula will be replaced by a fixed amount of 30%. The majority of countries that have adopted the BEPS Action 4 recommendations are going to be using this 30% limit. And interestingly enough, in the explanatory memorandum to the Draft Taxation Laws Amendment Bill, SARS said that using the micro level data for all taxpayers, it shows that by applying this fixed ratio of 30%, it would allow the majority of taxpayers to deduct all their interest without restriction. This obviously remains to be seen. And there are new rules which address certain back-to-back arrangements, which previously allowed taxpayers to avoid the application of Section 23M. Actually, there's a fourth important amendment, which is that there will no longer be an overall exclusion from the application of the provisions of Section 23M where withholding tax on interest and an exemption from income tax applies in the hands of the creditor. So instead now, what will happen is a debtor will be allowed a full deduction on a pro rata interest expense. So for example, where a creditor suffers, say, 5% withholding tax in terms of a DTA, the debtor will be allowed to claim a full deduction of 5/28% of the interest expense, so 5/28 of the interest expense, but the remainder of the interest expense will be subject to the potential limitation. Those are the four main amendments.
Yeah, no, thank you very much. And it's a provision that is quite complex because you've got to do lots of analysis determining whether there's a controlling relationship, particularly where you have multiple tiered group structures. And it's also an amendment where Treasury had said that the implementation date of this amendment will occur in future when there's a reduction in the corporate income tax rate, which will be announced in a future budget speech, the February budget by this. So when that announcement is made, then these rules will come in. But they do give a very clear signal as to what is to come, as to what is to happen. So taxpayers will be able to prepare for that eventuality.
That's right, yes.
Yeah. The if I could just change at this point, I saw a question coming through on the Q&A, and I'm going to make it a bit of a poll and just ask you to give your views on this. It concerns capital gains, and obviously the capital gain, we get taxed on the gain which is made while we're holding an asset, and if it appreciates in value, that gain gets taxed. So the base cost operates as the tax-free shield. Whatever we paid and the expenditure that we incurred in acquiring that asset is our base cost. As the asset grows, the amount above the base cost gets taxed as a capital gain. The question is, we don't have any type of indexation or consumer CPI discount for the holding period of that gain. So much of the gains that we have are quite illusory, they're inflationary. It's not a real gain, but we get taxed on that gain. What do you think is the likelihood? And obviously, we're all just speculating here. What do you think is the likelihood that Treasury would entertain a proposal that there should be some sort of indexation built into the capital gains tax regime, so that where we do hold assets for long periods of time, that we should determine the gain with reference to excluding those inflationary gains built in? Do you think it's likely in the current environment, or do you think it should be done? And do you think it will be done? A proposal like this will be made? I'm putting that out to all the panelists.
So my view, Mansoor, I think it's unlikely, because what will that do is then sort of decrease the tax base instead of increasing it. So in light of the current circumstances, economic circumstances where we find ourselves in, I think it's unlikely that National Treasury will entertain that sort of request. But that is just my view.
Okay.
I think I'm in agreement with that. I don't think that's very likely.
Okay. Do you wish to offer a view on that one, Anaz?
Yeah, I think it's very interesting, and I'm gonna say that I'd like to give it some more thought, because it's not something that I've seen, and I'm just wondering whether it's something that occurs, in other jurisdictions, internationally, to set some sort of an international precedent. So, yeah. I mean, I think it's very interesting, and if there is some sort of precedent, then I think certainly position like that could be put forward as well.
And I've seen it in other economies, because on the one hand, in our Treasury documents, they often take examples from other jurisdictions and they say this is a global trend, and therefore we're not doing anything different to what's being done globally. Whereas in this instance, there's an indexation approach. I think Australia applies it as well. That's simply not applied here. And I just couldn't pick up a tax policy reason why it shouldn't be done. Because if the idea is to tax you on gains, it should be a real gain, not an inflationary gain. But if I could then, just moving away from that question, Mangali, so it comes back in tax administration. side of things. You mentioned earlier on about SARS utilizing the windfall to hire skilled auditors on the tax side and the customs side and data scientists to boost compliance. You also mentioned earlier on about the fact that they would rely more on third-party data. Are there any other initiatives, and maybe I could just put that open to you, Mangaliso, as well as you, Anaz, that taxpayers should really be mindful of insofar as revenue raising measures from SARS is concerned?
I think, Mansoor, what taxpayers should be aware of is the increasing capacity within SARS. And what that will mean for them. And I think that it is a good thing for SARS to increase its capacity and for them to be able to undertake those complicated or complex audits. So, but what I think with what it's going to mean for taxpayers is that we are going to see more audits, we are going to see more disputes, and we are going to see more litigation. Now, SARS is very proud of the fact that they have a very high win rate when it comes to litigation in the tax court and the high court. But I don't think that should deter any taxpayer who has a legitimate case against us. Taxpayers are free to protect their rights, and where they do feel that they have the grounds, they should not be perturbed by the fact that SARS has a high win rate. Every case depends on its own facts. So I think taxpayers should definitely prepare for more audits, more complicated audits, more skilled tax auditors from SARS. So in general, we're going to be seeing more disputes with SARS going forward.
Mansoor, from my side, I could just add to what Mangaliso is saying, and that would be taxpayers need to look out for stricter enforcement measures from SARS. We've seen recently, on the personal income tax collections, there's going to be a new once-off admin penalty for the late submission of a return, or, on those taxpayers that were selected for auto-assessment and then failed to accept or decline or edit it. So I think stricter enforcement is SARS sending a clear message that they're trying to reward good compliance and deter non-compliance from taxpayers.
Okay. If I could, thanks a lot, Mangaliso and Anaz. If I could get back to you, Ntebaleng. Normally, when SARS puts forward the enforcement measures, we'd say, look, don't liquidate the company, because then you just lose a revenue base completely. There's a tax base that's gone. Have you seen any change on that front when it comes to SARS exercising the enforcement powers?
And I think it's actually gone the other way. They've become quite a bit more aggressive, and they are actually invoking that power to institute liquidation proceedings against taxpayers. So I think taxpayers just need to make sure that they make full and accurate disclosure, like Mangaliso said. And if they do run into financial trouble, just we know that the first thing that happens is suddenly people stop paying their PAYE, they stop paying their VAT, because they'd rather pay creditors and employees so that their operations keep going. But if a taxpayer does run into financial difficulties, they shouldn't just ignore the tax debt and just not pay it and hope for the best. It's best to go to SARS and try to enter into a payment arrangement or a compromise if it's appropriate. But also with the liquidation, I think it's not always a bad thing, especially where the likelihood of financial recovery is slim to none, that the taxpayer just stop digging the hole and just start on a clean slate. So SARS collect what they can collect, because although they are taking away a taxpayer essentially from this tax base, it would be negligent, I think, to leave the situation to get so dire that even when the company is liquidated, that there is nothing to collect. So I think a balancing act, and I mean SARS has the right to institute liquidation proceedings, and we're seeing that they are using that.
Okay. I see that we've reached 1 o'clock. The hour has actually gone by very quickly, I must say. I've been keeping my eye on the Q&A button, but I've also seen some questions coming through on the separate chat function, which you just haven't been able to get to. What we will do is look at those questions and then send out some responses to that. We won't be able to run through them now, but we will look at those questions and send out some responses to them. I'd like to thank everyone who joined in on the webinar, as well as the panelists, and Tebaleng, Mangaliso, and us. Thank you all very much, and the organizers, and thank you, and everyone have a good rest of the day.
Thank you.
Thanks, everyone. Bye-bye.
Thanks, everyone. Bye.
Bye-bye.